So next topic, this is about capital allowances. Capital allowances, if you remember from, if you have passed your ACCA paper F3 or F7, you remember the concept of depreciation. And you remember that you have non-current assets and then you charge depreciation on the non-current assets. And then that depreciation we used to put in our income statement as operating expense to calculate our profit, if you remember so. Capital allowance, this is the same concept. The only difference is that the depreciation, if you remember, which we used to calculate, it was using some straight line method or reducing balance method. And we said that the life of the asset is, 5 years, 10 years. And you used to remember, you used to calculate depreciation at the rate of 20% or whatever. Now, the thing is that was IFRS accounting. And that was when you were preparing your income statement and calculate your accounting profit. Accounting profit means the IFRS profit. The tax department does not allow it. That depreciation, which you used to calculate in F3 and F7, the tax department does not allow you to take that depreciation expense into your income statement. So instead of the word depreciation allowance, the depreciation, in tax accounting, we use the word capital allowance. So capital allowance is the same thing, which is, it is the same. You just can remember that you have for tangible assets, depreciation, for intangible assets, amortization. So for tax purposes, the name is not depreciation, the name is capital allowances. And capital allowances in the UK tax, we calculate on different types of assets with different rates. Just like if you remember, you have two methods, reducing balance and straight line. And then you could have decided that my life of the motor vehicle is 5 years. So straight line method, 20% depreciation per year. That was IFRS accounting. In tax accounting, you calculate capital allowances, and those capital allowances will be taken as expenditure into your income statement to calculate your taxable profit. So there are two words, accounting profit, which we calculate for IFRS purposes, and taxable profit, which we calculate for paying our taxes. So instead of calculating depreciation, we will calculate capital allowances and take those capital allowances into our income statement as our operating expense, and then find out our taxable profit. Now, just like you had two methods, reducing balance and straight line in IFRS, in UK tax law, we also have multiple methods. Those multiple methods mean that what you do, you divide your assets into different categories, into different types, and then on those different categories of assets, you calculate different, you apply different percentages, 8% or 6% or 3% or whatever. And then you calculate the capital allowance. So you people are already familiar with the concept of calculating depreciation. This time we are going to calculate capital allowances. What we need to learn here, that in how many categories can we divide those assets? And what are the percentages, or what are the rules for calculating those capital allowances on that particular special category or group of assets? So this is introduction to this topic. It is not something which is very unfamiliar to you. Once you understand that, oh, this is the depreciation, this is the official depreciation, this is the tax depreciation. So then you start feeling comfortable that I already know the idea behind it. So let's see, what do we need to do here? Define plant and machinery for capital allowances purposes. So you have plant and machinery. We know that one of the type of non-current assets on which we use to calculate depreciation. So now we need to see that how plant and machinery is treated for the tax purposes. Compute writing down allowances, first year allowance and the annual investment allowance. So these are writing down allowance is that depreciation thing. First year allowance is a special category. Annual investment allowance is another special category. Compute capital allowances for cars. For cars, there is a special treatment. Compute balancing allowances and balancing charges. Balancing allowance and balances charges is like last year thing. If last year you have more residual value left, so you need to calculate extra capital allowance, or if there is less, though you have a balancing charge and balancing allowance. So this concept was not in balancing allowance and charges. Also, we do for IFRS in F7, but not in F3. So it is the last year closing. We will see how much is remaining. So based on the residual value, I will explain this thing. Okay, it's not difficult. It's very, very, very easy. Compute structure and building allowance. This is called SBA, structures and buildings allowance. This is another special category. Recognize the treatment of short life asset. This is another category, very easy, one line treatment, one page slide. So these are recognize the treatment of assets included in the special rate pool. So special rate pool is a separate pool. So you see here already what you have. You have got a main pool in which most of the assets will come. Main pool, most of the assets will come. And the rate will apply 18%. I will show it. We will do many questions. I'm just giving you an idea so that you remain confident. You don't get confused. So you have a main pool of assets, and the main pool of asset, you charge 18%. And by the way, we don't use straight line method in tax calculation. Whenever you calculate capital allowances on for tax purposes, you always use reducing balance method. 18% allowance, 18% rate we use for main pool assets. Most of your assets, they belong to main pool assets. Out of that, there are some exceptions. Some of the assets, they are not into the main pool. So we call them, special rate pool. You have short life assets, you have annual investment allowance, you have. So mainly these four will work: annual investment allowance, main pool, special rate, short life assets. Compute capital allowances, the main pool, super deduction of 130% and special rate pool. This is something which has come new, like last 2 years ago. It came into the syllabus. We call it super deduction. So not really difficult. I will explain you that also. So these are all the topics which we are going to discuss. So allowances on plant and machinery, the first category, the main category. Capital expenditure is not deducted in computing taxable tradable trade profits when the accrual methods of accounting is used. But it may attract capital allowances. So this is actually the same sentence. It is not something difficult. It says capital expenditure is not deducted in computing taxable profit, which means that whatever, if you purchase an asset, capital expenditure is purchasing of non-current asset. Capital expenditure means when you buy a non-current asset. So it means that if you purchase a motor car for $20,000, you cannot show it as an expense in the income statement. Yes, we know that. If we purchase a non-current asset, we do not do that. Instead, you use capital allowance. Instead of taking this all 20,000 into your profit and loss, remember we used to take depreciation in an income statement. So we said balance sheet 20,000 asset will go, and the depreciation on that asset will come to the income statement. The same logic is here, that this capital expenditure which you make, the capital allowance, which means the depreciation on that asset, it will come to the income statement. So this first sentence is something you already know. Capital allowances are treated as a trading expense. Yes, capital allowance means depreciation. Whenever the word capital allowance comes to your mind, translate it, retranslate it, because you are very familiar with the term depreciation. Just think it is official depreciation. This is the depreciation for the tax purposes. So the capital allowances are treated as trading expense and are deducted at arriving at taxable profit. Yes, we know. Balancing charges, effectively negative allowances, are added in arriving at those profit. Balancing charges or balancing allowance, there are two words. This is where we use it in the last year. Balancing charge and balancing allowance. They both will happen when it looks like that you have, charged more or less depreciation. I'll give you one example. Okay, let's suppose. I will explain it in detail in the end, but because this word has come second time, balancing charge or balancing allowance, so you might be now thinking your mind is, knocking you. And so let me just give you a very brief idea. In detail, I will explain later. Let's suppose that I have an asset which is for 20,000 and I have to charge depreciation of whatever. And I say that the last year, the asset value should be 5,000 or asset value should be 4,000 in the end. So year 1, year 2, year 3, year 4. So in year 1, I charge depreciation, for example, I don't know, 4,000. In year 2, I charge again depreciation, 4,000. Then I charge depreciation, 4,000. Okay, let's say like this. The closing value should be 3,000. Residual value should be 3,000. And in year 4, I again charge depreciation of 4,000. So how much capital allowance I have charged, or how much depreciation? So 4 plus 4 plus 4 plus 4, 16,000. So it means that out of 20,000, I have charged 16,000 of capital allowance in 4 years, which means the depreciation 4 years. So the remaining book value is 4,000. Your book value becomes 4,000 because and this is called written down value. Remember net book value, NBV in F3, cost minus accumulated depreciation. We used to call it net book value. This time we will call it WDV, written down value, or TWDV, tax written down value, which means what is the written down? The decreased. To write down means to decrease. What is the decreased value in the books? So you can think like NBV or WDV is same. So the written down value is 16,000. 16,000 is the depreciation. 16,000 is the depreciation, and the written down value is 4,000. Now you had said before that you should have a residual value of 3,000. It has 4,000. So it means that you charge less depreciation. So you should be charging more depreciation. Or maybe what you can say, and alternatively, don't decide about residual value. You have an asset, you use it in year 1, year 2, year 3, year 4. After year 4, in the textbooks, according to the tax law, the asset has a written down value of 4,000. And then you sell this asset. When you sell this asset and you sell it for 5,000, so it means that you charged the book value, you have decreased to 4,000. So you have charged more depreciation, or you have charged less depreciation, because the written down value and the sale value are not same. So when an asset in your books for 4,000, you are selling it for 5,000. So what you are doing? You are doing $1,000 gain. You are making $1,000 gain on disposal. On this gain, definitely you need to pay tax. And that tax is called balancing charge. That's all. The extra tax liability which you incur at the end of the life of the asset is called balancing charge. Because what happened that if the sale value is 5,000, so it looks like that you charged more depreciation. You actually should have charged only 15,000, so that the book value should have been 5,000. Because you charged more depreciation before, and more depreciation means you paid less taxes, because when depreciation is more, expense is more, and profit is less. So you paid less taxes before, and those less taxes you have to pay now. You will not pay 1,000, but 1,000 is the gain. On this gain, you multiply with the tax rate, and that you have to pay to the tax. This is called balancing charge. Balancing charge means additional tax which you will pay if the asset has a higher market value than the written down value. If the market value is more, it is sold more. But alternatively, it is also possible that you have this asset and with $4,000 written down value, and you sell it for only $2,000. So if you sell it for $2,000, you actually have something on the balance sheet 4,000, which you are selling for 2,000, you are making a loss. If you are making a loss, so how much is that loss on disposal this time? The loss on disposal is 4,000 minus 2,000, 2,000. So you are making a loss. So tax department should give you a benefit, and that is called balancing allowance. Balancing charge and balancing allowance. Here you will get a balancing allowance. So 2,000 multiplied by the tax rate, this much of tax benefit you will receive. And this happens in the end when the asset is settled. Balancing charge, balancing allowance. The result, it is only happening when you sell the asset or it has a fair value which is different than the written down value. If the written down value and the market value of the asset is not same, if the written down value, because what happened, that written down value is the result of your capital allowances. If the written down value is not equal to the market value, the fair value, or the sale value of the asset, in such a situation, it means that the capital allowance which was calculated before was not correct. So therefore, we need to make an adjustment. It only happens when these two are not equal. If these two are equal, then there is no problem. But if the written down value is more or it is less, that will result in a capital allowance or a capital charge. So I did not actually want to explain this concept here because it will come later, but because it is written on screen twice, so I thought that I should speak about it. Otherwise, you people would, keep on thinking about it. So capital expenditure on plant and machinery qualifies for capital allowances. Both unincorporated businesses like sole traders, whether you are sole trader or you are company, they both are entitled for capital allowance, which means that sole traders and companies both can calculate the capital allowance, the official depreciation. For completeness in this chapter, we will look at the rules for companies only. This is, you should remember. This is an exception. They won't ask you an exam a lot, but it might come. For the purposes of taxation exam, unincorporated business, which means a sole trader, which uses the cash basis of accounting. Remember, we have cash base of accounting and accrual base of accounting from ACCA F3 and F7. So if you are using cash based accounting, accrual based accounting means that you record the transaction, the period to which they belong. Cash based accounting means you don't wait for cash to go in or come out. Transaction happens, you record it. So if a business is recording cash basis, they will give you in the question that the business uses cash basis. They will tell you, or the business uses accrual method. So if the business is using cash, if it is unincorporated, and it is because incorporated business cannot use cash basis, by the way. If it incorporated business means company. So a company cannot use cash basis. For unincorporated businesses like small businesses, sole traders, it is their choice to use accrual or cash. Why do they give choice? Why are they given choice? Because these are small businesses. Accrual accounting, sometimes it is difficult because you need to calculate accrual for all incomes and expenses, which may become challenging. So therefore, small businesses, they are allowed that they can choose whether to use the difficult accrual method or the simple cash method. And many say, I will use the simple cash method. So if they use simple cash method, then capital allowances are not available. Then capital allowances are not available. Just remember this point. For unincorporated businesses, capital allowances are calculated for periods of account. Periods of account means for 12-month period. These are simply the period for which the trader chooses to prepare accounts. For companies, capital allowances are kept for accounting periods. So I will explain you period of account and accounting periods. We will discuss this thing, okay? So period of account is actually the period for which a company has decided. And accounting period comes with reference to the tax period. So we'll talk about the tax bases and so on. For capital allowance purposes, expenditure is generally deemed to be incurred when the obligation to pay becomes unconditional. Obligation to pay becomes unconditional, which means that you must pay. And when do you must pay? When you receive the delivery of goods. So we will assume that it's not about, so if I purchase an asset, okay, I purchase an asset in January. I receive the asset in January. It is possible that I make payment in March, 2 months later. So if you have to calculate capital allowance, are you going to calculate from March when you made the payment for the asset, or should you calculate from January when the payment becomes unconditional? Unconditional usually is when you have received it, the asset. So it says that expenditure is generally incurred when the obligation to pay becomes unconditional. So if you have received the asset here, so you should be calculating from this time period onward. So you should calculate that how many months of capital expenditure, capital allowance I should calculate. My calculation, the depreciation, capital allowance for the period, 6 months, 8 months, 10 months, or 12 months. How many months I should calculate, when it should become, when I should start calculating it. Generally, when it becomes unconditional to pay, unconditional to pay is a time period, usually when you receive the asset. Payment you may make a payment after 6 months. That does not matter. So plant and machinery allowances are only available for expenditure on plant machinery which performs a function in the trade rather than provide a setting within which the trade is carried on. Now, what does that mean? So you see, there are allowances. Like I told you that you had two methods of depreciation, straight line reducing balance. So here I'm not saying depreciation, I'm saying allowances. So one type of allowance is available on plant and machinery. So plant and machinery allowance, we call it. Then you have allowance on cars. Then you have allowance on special rate. So allowance on building and structures. So allowances on plant and machinery. So first we need to understand what is plant and machinery itself. So plant and machinery is actually plant and machinery itself. And it does not include the environment in which it is set up. For example, if you have to put some machinery and plant, and this is some job floor, this is your small room or factory floor or whatever, and you put some machinery here. I don't know how to make some machinery. This is some machinery which is fitted in. So plant and machinery is only this part. The building itself or the structure itself is not plant and machinery. So it says that the allowance, machinery allowances are available for expenditure on plant and machinery, which performs a function in the trade rather than setting. Setting means the environment within which the trade is carried on. So you cannot say that my furniture and this and that and everything is plant and machinery. No, plant and machinery is only that particular piece of equipment which is performing the function. For that reason, capital allowances are available on cars, most factory and office machinery and equipment. They are not available to relieve expenditure on buildings or structures, including doors, floors, windows, bridges, waste disposal. We will have a separate category for them. Allowance on plant and machinery is not. You might have buildings, okay? If I'm not saying that, it says that they are not available on building or structure. So it does not mean that you cannot calculate allowances on building and structure. The thing is that allowance on plant and machinery is only allowance on plant and machinery. Allowance on building and structure will be called, you will have, SBA, structure and building allowance. We call it SBA. That is a different category, SBA. We will study it separately, okay? So plant and machinery allowance. Some integral features of structure, however, do qualify as plant and machinery. We will discuss it later as well, that some integral features of structures. So I said that structures are not plant and machinery, but some part of the structure might be included in plant and machinery. I give you an example. I mean, we will discuss it later, but just for because it is coming in mind that, okay, structure is not plant and machinery. And then you say that some part of structure might be plant and machinery. So what could be the example? You have some equipment, some machinery, which has some exhaust, some smoke or some heat exhaust, and you build a chimney in your building. You understand that exhaust pipe. That exhaust pipe, actually, without that exhaust pipe, this equipment will not work. It is connected together. So although that exhaust which you will make, that duct or exhaust which you would make, that is part of the structure of the building, but it is an integral part of that equipment. So that might come inside. That might attract allowance for plant and machinery. Main pool for plant and machinery. So all plant and machinery we put together, different types of plant and machinery we put together, and we call it main pool. The word which we assign, we call it the main pool. Qualifying expenditure, what can go into the main pool? Most expenditure on plant machinery, including expenditure on cars with CO2 emissions of 50 gram kilometer or less. So it means that those cars, so plant and machinery are inside the main pool. That we understand. But it also has exceptionally added cars. Those cars with CO2 emissions of 50 grams per kilometer or less, they are also put into the main pool. And it is possible that during the year, you might be making some increases, or maybe you are making some decreases in the main pool. Because every year you buy more assets, you buy some equipment, it goes to the main pool. You buy a new car, which has CO2 emissions less than 50 gram, goes to the main pool. Then you sell some old equipment, it is going out of the main pool, so it decreases. So it's exceptionally, the following items are not put into the main pool, are not included into the main pool. This you need to remember. Which one are those? Number one, assets dealt within the special rate pool. This is a separate pool. So main pool, remember now, before I move on, let me just tell you that this main pool has a depreciation or capital allowance of 18%. 18% is charged on the main pool. Now, but not everything is in the main pool, which means, and this is, by the way, probably the highest maximum value. Assets which are in the special rate pool, because you have another classification of asset which is called special rate pool. So special rate pool assets are separate, they are not in the main pool. Assets with private use by the trader. If there is a private use of asset by the trader. Short life assets. Short life assets where an election has been made. Short life asset means assets, some short life asset, maybe less than a year or less than 18 months. So those assets we can make an election and then you take them straight to P&L. So they are not added into the main pool. And these exceptions are dealt later in this chapter. Yeah, we'll discuss them later because we have a separate topic I'm going to have separate. This is a separate topic. This is a separate topic. This is a separate topic. So of course, we are not going to discuss them here. We just tell that these are not included. Okay, writing down allowance, WDA. Writing down allowance. This is your capital allowance, okay? Writing down allowance. Allowances called writing down allowance are given at a rate of 18% for a 12-month period of account on the tax written down value. So number one, you see your rate. So this is writing down allowance, the same like the depreciation, official depreciation. How much you charge? You charge 18% writing down allowance. And with 18% of the cost, straight line, which method? No. Written down value, tax written down value, which means reducing balance method. For example, if you have first year an asset for 100,000 and you charge 18%, so it makes 18,000, okay? So you subtract 18,000 from here And what is remaining? 82. So the next year allowance will be 82,000 into 18%, and that is 82,000 into 0.18. That makes me 14,750. So then I subtract 14,750 from here. And what do I get? Minus 82,000. 67,000 for 240. And then on this, I multiply with 18%. So these are called tax written down value. The net book value, TWDI, this is your TWDV for year one. And this is your TWDV for year two. Tax written down value. Kind of net book value. So not kind of, exactly. For example, in my IFRS, what I do, I say cost less minus depreciation. And what do I get? Net book value. In my textbooks, I say the cost, and then I have this WDA, written down allowance or capital allowance. I subtract it, and what do I get? TWDA, tax written down value. So written down allowance and tax written down value. I mean, numbers will be changed because this method is a different method. This method is a different method. Cost might be same. It is quite possible that cost of the asset was 100K here, and it is also 100K here in both books. But this method of depreciation or this calculation is different, and therefore these numbers will be different. Anyways, we are not talking about this. I'm just showing you this IFRS so that it becomes easy for you to understand, because I know you guys have done F3. Many of you people might have done F7, but at least F3 you have done. So you know depreciation concept. That's why I'm so frequently making a relationship between them. When plant is sold, proceeds limited to maximum of the original costs are taken out of the pool. Yeah, of course. When you will sell it, for some equipment. So proceeds limited to maximum of the original cost are taken out of the pool. So if I'm selling the plant and I receive some money, proceeds, I should be decreasing it from the main pool, that these assets are gone. And maximum what you can reduce is the original cost. Of course, more than that I cannot. More than that I cannot. Next topic is annual investment allowance. I'll explain you annual investment allowance, and then after doing this topic, we will do some question together. Now, this is the second category, by the way. This is the second. I have not done any question for this one because this first main pool and plant and machinery we discussed. Next topic, we will do the second category of asset, which we say annual investment allowance. And once we are done with both of them, after that, we'll do some questions. So let's take a break, and then we do it after the session.